Alright guys, my experience in the markets has made me to realize that there is no strategy that is 100% correct. Even with a profitable strategy with an edge in the market will always be changing according to supply and demand and various factors and reasons. For example, we have geopolitical events, we have natural disasters, trade wars. We have a whole lot of things that can actually change the shape of the market after you place a trade or before you place a trade. So when you have that in your mind, you know and understand that a stop loss is very, very important. So before we go any further, guys, if you are new here, I would kindly ask you to click the thumbs up button to subscribe to this channel and click the notification bell so that each and every time I record a video or I post a video like this, you'll be the first one to be notified. All right, so let's talk about stop loss. I know that for many people, when they hear stop loss, for them or to them, rather, it's actually something that they are not interested in. It's something that reminds them of a horror movie, a horror event, or something that scares them, because I believe that each and every one of us at one point we've had our stop loss taken out. Whether you lost a small amount of money or you lost a large chunk of money, we all have been a victim of a stop loss being taken out. All right, so stop loss, what is this thing? So basically with a stop loss, you're simply saying that if I do sell in the markets, let's take for example, I do sell here. If I sell here, right, I'm saying that if the market comes back against me, right, if I sell here, I'm anticipating that the market is most likely going to go in the direction of the downside. But in the event that the market decides to buy like this, I'm saying that I want to be out. Whether I'm looking at the markets or I'm looking at the charts or I'm not looking at the charts, I want to be out of the market to protect myself. So basically, in a nutshell, a stop loss is there to stop you out of the market, to protect your capital, to protect your positions, and also to help you manage your trades. Let's say, for example, you are not watching your screens. So it's actually good for you. I know that we have traders who say that don't use a stop loss. I believe the majority of us are retail traders with small accounts. We're trying to grow and we cannot afford just to lose money or to blow our accounts because we don't want to place a stop loss. So the stop loss is actually good for you if you know exactly how to use it, right? So this takes me to this point. I need to emphasize that a stop loss varies, number one, with the pair that you're trading. It varies with the market that you're trading and the time frame that you're trading. There's no such thing as a fixed stop loss. I've seen many people saying that, you know what, I'm a trader and I'm interested in trading 20 pip stop loss, right? That might work for a particular pair that you have studied, maybe a less volatile pair that you know that, okay, on average, Euro USD or GBP USD is going to give me a stop loss like this based on the time frame that you are trading. For example, I'm going to show you something quickly, right? If we are looking at this chart, this is the dollar index chart, right? If we place our stop loss right here, let's say we enter on this candle close and we place our stop loss right here, okay? According to what we see here, we can see where our stop loss is, right? But when you scale down to the M15 time frame or to the H4 time frame or to the daily time frame, you see that these time frames are actually totally different. For example, let me just switch quickly to the daily time frame. So if I switch to the daily time frame, we can all see where the stop loss is, and I'll explain why. Let's say you want to put it behind the structure. We can see now the stop loss has actually changed, right? Let's go back to the H1, right? Now, if we come back to the H1, we can see that where we placed our stop loss here, this is actually so far away from the initial stop loss placement. And this is largely because of the time frame difference, okay? So remember this, every pair has got its own volatility. It has a unique way of movement, and also every market is unique and every time frame is unique. So some people trade the H1 time frame, the M15 time frame, the H4 time frame. Remember that. So if you are a person who's just saying, I'm just going to put a 5 pip stop loss, then you are actually destroying yourself. Okay. And now let's go to the next point. Okay. Your stop loss must be defined by technicals. Okay. Let me explain that. You do not just guess your stop loss. You don't just come out of nowhere and you say my stop loss is 30 pips and I trade 30 pips stop loss, right? Why am I saying so? Each and every strategy has got its own way of entering the markets, right? I'll give an example here. I'll use an example. Some people are range breakout traders, okay? Let's take, for example, this is a range that has been broken. Some people are range breakout traders. And I've seen people who say that, you know what, I enter the markets when the market breaks out and I want to see enter based off of the candle that closes below the range, and I'll put my stop loss just above the candle that breaks out. I'm not teaching you a strategy, guys. I don't trade like this, but I'm just trying to put everyone in one bracket and to show you the various ways in which people look at the markets, okay? This is one person. Another person might come out and say, you know what, I'm entering, or I'm placing my stop loss or my entry position right here, just after the break here, and I'm putting my stop loss just above this candle. Some might say above the peak of the range, right? Above this peak, okay? Above this peak, I'm going to put my stop loss. That is another person. The other one might actually say, you know what, I'm going to combine, or I'm going to put each and everything that we see here to make my stop loss. But with each and every stop loss adjustment that you see, you're going to realize this is just coming from the fact that technicals vary. We have people who are sniper entries who are trying to enter the market quite early and have a very tighter stop loss. I'll talk about tighter stop losses as we go, okay? Then there's somebody who's just saying, you know what, I don't mind just having a bigger stop loss. So remember this, your stop loss is defined by the strategy that you're using or the technicals that you're using. You don't just guess, okay? So you place your trade, you place your stop loss based on your strategy. Whatever you would have analyzed in the markets, and then you say, okay, I'm going to enter here, and then I'll put my stop loss, okay? Some will say 2 candles behind, some will say just behind, some will say, okay, I need to push away from, just put it away from where the price is. I will explain as we go, okay? So now, remember this. Personally, this is what I believe in, or this is what I like to understand, okay? You want to understand structure if you are a trader. Whether you're trading, I don't care the strategy that you're trading. You need to understand structure. Basically, market structure, where you see the market creating lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, right? Lower lows. Okay, so we have what we call trend points. And what are these trend points? These trend points are the points that I was just referring to. For example, this one, lower high, and then this is a lower low, and then a lower high, and then a lower low, lower high, and then we have a lower low. Okay, all right. So what I've realized is that when the market is selling like this, okay, these high points, these swing points are levels which are being defended. Okay, why am I saying so? For us to sell, or for us to move from this point, or to sell, to push all the way down, there were buyers and sellers who were actually trying to buy and sell in the markets. Some people actually placed their stop losses above this swing point. In other words, they were saying that I'm going to put my stop loss just above this swing point to protect myself from this movement. We had sellers selling, we had buyers trying to push. Obviously, they were going to put their stop losses just below, but that's not my point. So I want you to follow me carefully, okay? So if that is the case, if sellers sell here, if the market tries to come back, okay, let me use this different. If the market tries to come back to this point, we will see that sellers will try to fight and push to protect their positions. Why? Because that's where their stop losses are, or that's where the money is. Yes, we have some instances where the market will try to reach out for the stop losses, and I'll explain that as we go with the video, okay? So make sure you're following me carefully, okay? So I love to put a stop loss just behind these peaks or these trend points, right? Because that's where the market is starting to sell from, or these are the levels that are highly defended. That's where the initial sellers started selling from. Okay, so the market will try to protect. Now, what happens if we actually take out or fail these points? Then when we fail these points, what it means now to us is that structure would have shifted. Okay, so you want to understand market structure. Structure would have shifted, and therefore it's not just the market took me out, but it's also due to the fact that we might be having a trend change. Okay, so if you do not understand reversals, if you do not understand what I'm trying to explain here, you can watch my previous video where I explained the signs that you can actually see when reversals are about to happen. So which takes me to the next point, which I need to explain to you guys. Okay, so if you are a trader, it's very crucial that you choose a very good broker. We have so many brokers out there, and some of them are not even well regulated. And I think you understand, if you're a trader, that some brokers or most brokers are allowed to make money through spreads. Okay, we have brokers that are zero spread brokers, or they actually offer accounts with low spreads. Some actually tend to manipulate even more. Their spreads are much more wider. I don't know if you have been trading and you see that you open a position right here, you're selling. Okay, you sell here, and then you see the market, the spread will push all the way up just to try and absorb your orders. Okay, there's an indicator which you can actually find online. It's called a spread indicator. It will show you when you have entered the markets. It will show you exactly the spread that you have at that particular time. It will calculate for you, spread calculator, the spread that you have at that particular time and what is happening, especially times of news. So when you're choosing your broker, you need to choose a very good broker that is not going to manipulate you so much, okay, and take you out of your positions. Why is that important? That is important because if you understand the broker that you're using, the amount of spread, the maximum spread, we are going to add that. Let's take, for example, you enter a position right here. Let's say we sell here, okay? We sell here. And then you decide, okay, I want to put my stop loss just behind this. So a general rule of thumb behind this swing, let's say we sell here, you put your stop loss here. A general rule of thumb that I always tell people is that let your stop loss include the spread that you're choosing. Let's say I sell here. Let's say I sell here. I put my my initial stop according to the technicals is here. I'm going to add the spread. I'm going to add the spread right here that we have. So assuming the spread that we had was maybe 3 pips, and my stop loss, maybe my stop loss was, let's assume it was 20 pips, okay? Assuming it was 20 pips initially. So what it means is that if I add the 20 pips plus 3 pips, then I'm going to have a stop loss of what? A stop loss of 23 pips. I have included the spread. Why? Because the market tends to absorb, okay? You will see that sometimes, let's say you enter here. I'm trying to take my time, guys, so that I explain. Let's say you sell right here. As we can see, this is your entry position, okay? And your stop loss is here, okay? So if your stop loss is here, I've seen that sometimes we will have candles that will reject, or that will just poke above like this. The candles will just poke. We have a candle that will just maybe reject or enter within the zone. Sometimes we might see even a body getting inside this particular level. We might see a candle getting inside, let me just, okay, something like this. We might see a candle just getting inside the zone, and a candle will get close to this stop loss. So what the spread does is the market or the candle, you will see that the candle is just going to, the wick will just poke here. But because the spread is being open, sometimes they do have open spreads where they can open up to 7 pips. So you see the market will just open the spread, right? You might not see it physically. You might not see it, but you see a red and a blue line, depending on the platform you're using. You see your bid and your ask price. Sometimes you might see this will be doing something like, let me try to make this red. Okay, I'm trying to make it as clear as possible. Let's say we have entered here. Remember, your stop loss initially we put it here. You might see a candle, price will get to this level. This is your actual price, 106.756. So what will happen is that the candle, as you are looking at it, right? The candlestick or the candle, as you are looking at it, the closing price, or the closing price is here, but this is before it has closed. Let's assume this is a bullish candle. Let me see if I can make this a bullish candle. Okay. Okay, there we go. Okay, this is a bullish candle. The market is here, right? But however, we can see that the candle is still like trying to push and sell a bit, and then push up again, come back again, and then assuming the market is here, let's say it gets to this level, this candle, right? It's still a 4-hour candle, a 15-minute candle that is still running. What you might see is that, according to your eyes, you will see that the candle is just right here, but you might see a gap between the bid and your ask price line. And you see that on your, especially on your MT4, MT5, price will do something like this. So this is where you see many people are confused. They're asking themselves, but the candle did not hit my stop loss. What happened is because your broker or the platform you're using, the spread was more than, in this case, maybe it was more than the 3 pips that we use. The spread was open, especially when we have fundamentals, especially when we have news. You see that the market would, especially with many brokers, spread is not intact. So remember this, you need to have your stop loss with your technicals behind your peaks, okay? And you need to also accommodate what? Accommodate spread. And remember this, that spread can also be manipulated unless or otherwise you're using a 0 pip spread account, right? There are some brokers that will actually allow you to do that, okay? I hope this is clear. This takes us to the next point, okay? Avoid 1 pip stop losses. There's been a trend within the industry where we see people love to trade sniper entries. There is nothing wrong with being a sniper. I love that. Sniping simply means you are trying to enter in the markets with 0 to minimum drawdown and with high precision. But however, you should not affect the quality of your trade, the quality of your trade management and your risk management, okay? So I do not believe in a stop loss like this. You see someone placing a stop loss like this, 1 pip stop loss. You just put 1 pip here. Just put like a stop loss like this. Let's assume this is 1 pip, right? This is highly possible. But I'll tell you that in most cases, the market will take you out, not because you see that, okay, I've entered in the markets. However, the market just poked me out. You see something like this. You see something like this. You see that you would have entered, placed your stop loss right here, and then the market will just poke you just a little bit with this candle wick, takes you out, and then later you see the market would have moved in your direction, and you start crying. You say, brokers are after my stop loss. The market makers are after my stop loss. I understand that some brokers do manipulate, and we do have the market makers in the markets, but try to avoid being caught up in the wrong direction. Try to avoid silly mistakes. There's no need for you to prove a point by putting a 1 pip stop loss. So instead, let's assume your stop loss was very small like this, right? Why don't you just maybe add 5 more pips, make it a 5 pips or 10 pip stop loss? Remember, you don't make money because of your stop loss size. That is guaranteed by the sizing position or the lot sizing that you put, okay? So whether you have a big stop loss like this, if your lot size is big enough, you still make money. Yes, you have a high risk to reward ratio with the sniper entry, but never make the mistake of putting a 1 pip or 2 pip stop loss. Personally, I believe this is actually destroying traders, and it has destroyed so many traders. We do not control these markets, and the markets can actually change at any point. We have spreads, we have things that we cannot control, like geopolitical events that can actually affect your position, right? So now let's get to the next point. The next thing that we need to talk about is weak fishing. Weak fishing actually is another way that the market will take you out of your position. Let's assume that you were selling right here, and you would have placed your stop loss right at this particular point. Let's say you sold here, you put your stop loss just above this high, okay? Just above this high. What you realize is that according to the price action that we see here, we can see that above that high, this high point, this previous high, I'm talking about this swing point, this high, Okay, you realize that the market came back and then poked just above. Now, let's look at the psychology of this candle. We can see that even though the stop loss was not bad, even though the market was to sell, but what happened was that there was weak fishing, or the market took all these people out. The market took all these people out with a candle wick, triggered all the stop losses that were here, and then eventually the market sold. Now, is this a mistake of a trader, or is this the nature of the market? So there are things that we have realized over time, that the market tends to do what it wants to do. And these are some of the things that the market does, right? Whether it's manipulation or what, we know that sometimes just putting a stop loss above a high without giving it a room, right? Enough room, you will be fished out of your position. You will be fished out. So remember this, whenever you either you wanna give enough room, or you allow the market to fish you out. Now let's look at this candle. I want you to look at this. Notice also that this candle was once a bullish candle, right? This was once a bullish candle that tried to push to the upside, something like this. Let me try to mark. This was once a bullish candle. I don't know why it's not aligning exactly. Okay. This was once a bullish candle that tried to push price up, but sellers took over and it closed as a what? As a bearish candle. So meaning to say that what you can take out is that sellers are much more powerful. Buyers tried, but sellers took over. But then when you look at the weak distance from here all the way up, this is the range that so many people were manipulated and taken out of their position. And guess what? The candle did not even close above, just close below. Fished people out and close all the way down here. So some people will still have faith that the market is still going to come back and da 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 da. But you are out already. They've taken you out. Okay, so you want to avoid candle fishing as much as you can. Now, we also need to talk about stop loss placement now. Okay, remember I told you that based off of your strategy, I do encourage people to put their stop loss above peaks. Like in this scenario, we can see that the peaks that we see here, this is a peak because we had a breakout structure, and then we had a breakout structure, we had a peak. Okay, now having these things, we understand that, let's say I sell, right? Let's say I sell, assuming I sell here, I'm not going to put my stop loss exactly above this candle. Remember what I said. You want to try and put it above, but also look on your left. You will see a structural point. Like in this case, we had this candle. You see this candle rejection. That is the previous high just before the next point. So I would rather put it above here and then I sell. So you look to your left and you try to see a peak formation or a swing just above, because if the market is to sell, it will try and defend this point. Remember the technology that I've given you guys of swing points. If the market is to violate, it will try and defend these points or these particular levels. Okay, let's continue. Let's look at another example. Right, let's remove this. Assuming again that I sold, for any reason I sell here and I put my stop loss just above, right? And I sell. Don't put your stop loss just above here. Remember, because of spread, number one, because of weak fishing, and because of manipulation. I'll look to the left and try and see, is there a swing point that I see? Now, based on this, looking left from here, I can see that I have a high point here. That's where I'll put my stop loss. Why? Because if I do put my stop loss here, if the market decides to come and take me out of the market, I know for a fact that I am highly protected. If the market is to then take out this swing point, then it means my technicals are invalidated. It means my technicals have been invalidated. So let's continue. I'll do another example, one more example, and then we go. Okay. So assuming again, let's take, for example, we sold right at this particular point. Let's say we sold here. Let's say we sell, let me try to make it, let's say we sell here and this is supposed to be the high of the swing point. Okay. You don't want to put your stop loss above, but you look to your left to see, is there a high swing point? And in this case, we can see we had a high swing point right here. And that particular high swing point becomes my stop loss level, or becomes my stop loss point where I'm going to put my stop loss, such that if the market then decides to come against me, I know that, okay, that will be invalidation of structure. So remember that you put your stop loss, you try to look at the swing points, and then you place your stop loss, and you're going to avoid yourself from being trapped. Number one, weak fished and spreads. Okay, so let's go to the next thing now. For the last point, or the last thing that happens in the market, I'm sure you have seen ranging markets, right? See, the market is ranging, and then you see something like this, and then the market shoots up. This is what has destroyed so many people. Stop hands. Okay, this is what has destroyed so many people. What the market will do is that it will create sort of like a support point, and many traders are buying. These are buyers. They buy, they put their stop loss here. These ones, they buy again, they put their stop losses here. This one buys, places his stop loss here, and guess what? The market looks for liquidity, or the market looks for money, and then shoots all the way down to tap these people's stop losses, and then you see the market pushing up. Now, I want to explain that there are so many reasons that will cause this to happen. It's not necessarily the broker all the time, or the market makers all the time. This is just the market. To avoid this, sometimes you can avoid, either by saying that I'll use this as a strategy, to say that I'll allow the market to first of all push below certain peaks before I can buy, right? And then when you buy, you then put your stop loss, okay? Or what you can simply do is, you can say, okay, I have a certain point that is equal, that many people are looking at, watching out for. I will not enter there, but I'll allow the market to penetrate a bit, and then I look for a certain position somewhere there, and then I'll enter. This is not a strategy to say, but I'm just showing you what the market will do in most cases. So this is why it's important to always have a stop loss. It is because of things like this. So if you like this video, make sure you leave a like, click the thumbs up button, click the notification bell, subscribe to this channel, so that each and every time we upload, you are notified. Make sure you leave a comment as well. I'd love to speak to most of you guys. And ladies and gentlemen, this is BGFX Legend. Until the next one, a peace.